Welcome back to another Deal of the Week breakdown. My name is Ricardo Carrillo. If you're new here, I run a nationwide mortgage lending team. We help our clients and investors scale their real estate portfolio all over the entire US. We're actually servicing the entire US plus Puerto Rico. I'm also an investor myself, and one of the beautiful things about what we do is that we get to see what our real estate investors are doing across the entire US. And then I get to apply those strategies for myself, but at the same time, I get to also give that back to you guys and my other investors who get to see, what's working in different markets, what's not working in different markets. And in these deal of the week breakdowns, I really like to explain how we negotiate these deals up front. It's a lot of upfront communication with myself, the client, and the agent when we're trying to submit an offer on a property and we're trying to maximize our dollars. I'm a conservative investor, and one of the things that I look at when I'm trying to purchase a property is I want to maximize how much money I'm actually spending in order to purchase the property. I really love the deal that we're about to talk about because this kind of embodies the strategy that we follow where if we can negotiate a lot of money up front from the seller or just get creative in the way that we're going to come in with a different kind of loan program or you're out of pocket, it's ultimately going to save you money over the long term. And one of the things that I've seen over the years is that as people purchase more and more real estate, the most difficult part of the entire process is not finding the house. It's not finding the bank who can get us the loan. It's not finding the realtor who can help us, find the property. And it's not even underwriting the deal and making sure that the deal makes sense. It's actually getting the money for the deal. Talk to any real estate investor across any market, and they will tell you that the capital for the deal is the most difficult part. This is why people create syndications and real estate funds where they basically try to pool together investor money to go use that money to go buy real estate because the most difficult part is getting the money for the deal. Now, knowing this as an investor, the thing that I always like to look at is how can we maximize how much money we're actually spending on the property in order for us to be able to maximize your out-of-pocket cost, right? And so we can do that in two ways. The first way is that we can use a loan program that has a lower down payment, which is the most common. I have a lot of investors who come to me still to this day who think that they have to put 20% down in order to purchase a property, which is just frankly not true. There's so many loan programs that exist that allow people to buy properties without a 20% down payment, regardless of what you're trying to do with the property. If it's going to be a primary residence for you or an investment property, you don't have to put 20% down. There are other loan programs that exist. And then the second thing is how can we save the money up front when we're actually trying to purchase the property? And that comes with, can we negotiate with the seller? Can we get some sort of credits? Can we get lender credits? Can we get realtor credits to come and purchase this property? If the house appraises for more, is there a way for us to save some money? So these are the things that I like to look at. And these are the ways that we are able to help our clients save as much money up front. And this deal, it kind of embodies what I preach in regards to that strategy. This client came in with exactly their down payment to close. They did not bring any additional cash to the table in order to purchase this property. And I'm going to explain to you guys exactly how we structured it. Now, what I really like is that this client was a repeat client of ours, and they've been phenomenal to work with. But we helped them in their first investment property. They bought a short-term rental with us last year in Arizona, property that they purchased at that time. We did this exact same strategy. And so because of the fact that they already knew how we had walked through the entire process the first time, I re-explained it to them and I said, hey, let's just do the exact same thing again for this property. And what's crazy is that I'll tell you guys how much money they would have spent if they had used a different loan program or not had done this strategy to begin with. This is a client of mine who purchased a property in Arizona, and it's actually more in the desert area of Arizona. It was a single family house sitting on just a little bit under half of an acre. It was a beautiful desert property. I really like some of these Arizona properties that have the desert vibe because they kind of fit the short-term rental aesthetic. Pro locations like Joshua Tree or like this in Arizona, there's a lot of different markets where you can get really creative with the things that you want to do for amenities for people, and that's what gets someone to want to book your property and pay that extra money, right? Because they want to actually spend time at your property. They don't want to just have a place to stay. Otherwise, they could have just gone to a hotel. Living square footage for this property was 2,065. So it's just a little bit over 2,000 square feet. It was a 4-bedroom, 4-bath, brand new construction purchased directly from the builder. Now, because it was bought from the builder was the person who we went directly to, and I guided our client in structuring the deal where we actually didn't need any real estate agents. Now, because we didn't need any real estate agents, I explained to them, how we were going to be protecting their deposit, what were the ways that we could negotiate more money up front from the seller. And so the seller was the builder, and that was just, hey, you're not using any agents. That's 4 to 6% in commission that we could be using towards covering all closing costs, right? So knowing that, I explained to them, let's negotiate that money up front from the seller, and let's use that towards all of your closing costs, right? So this property is a little bit over 2,000 square feet, sits on 4 bedrooms. It's 4 bedrooms, 4 bath, and it only sat on the market for 19 days. Now, Frank, granted, the client actually purchased their previous short-term rental from the same builder. So we already had a relationship with them. He already had worked with us. We had done the exact same thing in our last time, except the last time we used an agent, and this time we didn't need to. My clients ended up using a conventional loan. Now, conventional financing is like the most traditional type of loan program that people use when they purchase a property. Conventional financing has 3 different types of occupancy that you can declare. So the first one is a primary residence. That's if you're going to live in the property for the first year. The second one is considered a second home, and that's where you might be using the property here and there. It might be a rental as far as Airbnb. It might be a property that you're just going to block off whenever you want to go there. So there's kind of flexibility there. And then the third one is doing it as an investment property. Now, when you do it as an investment property, the lender actually knows that you're going to rent the property. And so for that reason, they allow for us to use projected income that from the property that you're buying, right? So if you're buying a $500,000 house and they know you're going to turn it into a rental, they let us use that income to help increase your pre-approval. In this situation, we actually used the second one, which is a second home loan program. That program is by far my favorite loan program to use for clients purchasing short-term rentals. They're allowed to purchase a property with a minimum of a 10% down payment, which is significantly lower, right? If you guys remember at the beginning of this video, I mentioned you can purchase a property with less than 20% down. Short-term rentals, you can buy it with 10% down. We just want to make sure that we run the numbers and that you can actually qualify for the loan. Purchase price of this property was $650,000. Down payment was 10%, which came out to $65K. And the property had actually appraised for the same price. Not surprised, right? Most of the time, even if you have seller credits or some additional credits included into your contract, the property will still appraise for that price. And if it doesn't appraise for that price, we have the ability to do something called a reconsideration of value. A reconsideration of value is when we provide additional comparables to the appraiser in an effort to get them to give us an increase in value. I actually just had a client do this on a different deal that was a short-term rental. They had the appraiser who gave us rental income of $125,000 a year. Now, granted, this was almost a $2 million property. So that property should have had significantly more money in rental income. When we provided the additional comparables, the appraiser actually came back to us with nearly $400,000 in rental income, which is a massive difference. I'm just using that as an example. That's a future deal that I'm going to talk to you guys about once we get that wrapped up. But it was really cool to see how, providing additional comparables and actually knowing what we're doing when it comes to, talking to these appraisers and getting them to give us the valuations that we're looking for can actually significantly help when you guys are trying to get to the closing table. Interest rate that we were able to lock in for this client was at a 7.5% interest rate. Keep in mind that when you purchase a property that you're not going to live in, the interest rates are slightly higher than what you would see on a primary residence loan. Primary residences, where you tell the bank you're going to live there, is always going to get you the absolute lowest interest rates possible. Once you purchase a property that you're not going to be living in, it's ultimately more risk for the bank. And if we understand it from the bank's perspective, when people are going to stop paying their mortgages and they're going to default on a mortgage, let's say, the property that they're going to default on first is the property that they don't live in. So in an effort, in order for them to cover themselves, right, the interest rates are slightly higher on what you would see for second homes and investment properties due to the fact that it's not your actual primary residence. We ended up using a 30-year fixed interest rate. Now, although we do have other options as far as terms and not doing a 30-year fixed interest rate, I would say that most investors still stick to a 30-year interest rate. I typically provide my clients with different options to say, hey, here's what it would look like if we didn't do a 30-year fixed. Frankly, I just haven't seen that over the last 12 and 24 months, really, interest rates have not been better for adjustable rate mortgages. It's still an option, it still exists. It's just not as common for what people are doing on a lot of their properties. Principal and interest for this deal came in at $4,090 with 40 cents. Homeowners insurance came in at $123, which is relatively low, I would say, for homeowners insurance. Property taxes came in at $469 with 63 cents. Monthly PMI. PMI is when you are putting less than 20% down. PMI actually only exists on traditional loans. And so we have loan programs that exist in what we call the non-conventional space, where you're purchasing a property with just different kinds of qualifying ability, different types of requirements. And if you're putting less than 20% down on one of those programs, you actually don't have PMI. So it's just because this was a more traditional loan. PMI in that $100 to $150 range is relatively normal, especially if you have a credit score above 700, which this client did. Now, homeowners association, there was no homeowners association, so that is $0, leaving our total at $4,834 with 66 cents. Again, I mentioned at the beginning of this video that we were able to get our client to come in with no money out of pocket besides the down payment of $65,000. And the way that we did this was when we submitted the offer on the property. Now, the property was actually listed for less than $650K. The property was originally listed at $615,000. Now, we knew that the property was going to appraise for more because we had already purchased a property in the same neighborhood that had a higher value. And so what we did was two different things, which is, I absolutely love this. The first one is we said, let's negotiate 3% to cover all closing costs. And so we got $14,000 that came in towards seller credits to just wipe all of the closing costs. The second thing that we did was we got the developer or the builder, who was the one who's selling this property, to do work for our client to this property. Now, we knew that what we were trying to do was set this up as a short-term rental. And so we were wanting to have increased amenities, have some hardscaping, and have some landscaping that was completed. And there's actually a creative way that we can do this. We can get the seller to essentially agree to give you this money. Let's just use the example of $20,000. If you're spending $20,000 on amenities, you want to do something in the backyard, you want to do something in the front yard, we can get the seller to essentially pay this invoice, so to speak, at closing. Now, in this situation, it was a little funky because the seller was the builder, so they were going to be the ones doing the work, and we just got them to bake it into the price. We said, hey, let's increase the price of the property, and then you're going to agree to do this work for us before we close, which is exactly what happened. And then at the same time, we added in some wiggle room for our client to cover all their closing costs. So not only did they get the work that was completed on the property to get this done and have it look better by the time that it's completed, but we also negotiated the money for closing cost credits to cover everything. And this is a super creative way to, as long as the house can appraise, it's going to be able to hit the parameters that we need to cover everything that I just mentioned. I've done this countless times. There's so many real estate agents and other lenders who actually just don't even know that there's a strategy that exists. I've had clients who've negotiated upwards of $100,000, $150,000 in credits in order to do this, where they're paying contractor invoices at closing or getting a contractor to do some sort of repairs that they know they already wanted to do. They wanted to do some sort of roof repairs. They wanted to do some sort of hardscaping, some landscaping, some work inside of the house, whatever it might be. This is a strategy in order to maximize your dollars, get the seller to pay for more things, cover all your closing costs, and only come in with down payment to close. You can do this on any kind of property, residential or commercial, regardless of what loan program we're utilizing. It is by far the best strategy to scale your real estate portfolio. Total closing costs came in at $15,642 with 21 cents. We had negotiated $14,000 in closing cost credits, which pretty much covered all the closing costs. And then we had $1,120 in adjustments and other credits. That was money paid back from the seller due to the time of year that we were closing, leaving our clients total out of pocket at a whopping $65,000 with 521. dollars and 56 cents, which again, this is by far one of my favorite strategies. I would love to be able to help you guys set this up properly. You don't need real estate agents. Like in this example, I walked our clients through the entire process without needing to do that. For those of you who don't know, I'm actually also a licensed real estate agent in the state of California. I actually started my career in real estate. I was a transaction coordinator in 2019 for a massive real estate team, and I got my feet wet in the real estate space by working on the transaction coordinating side, the contract paperwork side, the real estate side, before I really dug deep into the mortgage space. And I just love being able to structure these deals for our clients where we're maximizing their dollars, we're getting them into their next investment property. And this client was able to purchase two properties in the span of 2 years, where the total combined amount of money that they spent would have been the equivalent to one deal. Had they put 20% down, had they had to pay their closing costs, had they not gotten a way to negotiate all of this money from the sellers, they would have had to spend significantly more cash just to do the work that they wanted to do to one property. All I'm saying by trying to say this is that the team that you have behind you is so important in being able to scale your real estate portfolio. And we have our clients who have worked with us for years to help them scale 7, 8, 9, 10, 11 properties. But for me, it's my favorite thing to do is the deal structuring, and making sure that we can save our clients money. Who doesn't want to save more money while getting more money in cash flow from your investment property? I hope you guys found this deal of the week informative. I know it was a little bit longer than my typical deal of the week videos. And if you guys haven't seen my other deal of the week videos, you should totally check those out here or here. I will see you guys in the next deal of the week.